Bull call spread with a naked leg. A bull call spread is where you buy call A, then sell call B with a higher strike price, as well as sell a put under the trade. You use a trade like this when you think the market will go up and the downside is limited, and the straight call option is very expensive, and you want to be able to get a long call, get long an option with a closer strike price and reduce the amount of cash you're laying out. The goal is to make the trade free or a credit or very low cost. The profit is limited to the difference between the strike prices plus the premium collected for the put. At expiration, the break-even is equal to the long call strike price plus the net amount paid for the spread. Now, the risk on this trade is unlimited because of the naked leg, the naked put. The market trading below the short put is equal to being long. It has the same risk as going long the futures from the put strike price plus the net amount paid for the spread. Now, at expiration, if the market is between the short put and the long call, you'll only lose the net amount paid for the spread if you're paying. Here's an example of a bull call spread in the Dow Jones. It's a bull call spread with a naked leg. Here we're buying the primary moneymaker, the 104 call, selling a 106 call. This is our bull call spread, and our naked leg is a 106 put. Now we're collecting $700 on the 106 and collecting $720 on the 102 put, which offsets the cost of the 104 and reduces the whole trade down to an $80 debit. In other words, you're going to pay $80 for the spread plus commissions. Now, in a trade like this, there are 3 commissions. There's 3 legs. Your intrinsic break-even on a trade like this, because you're only paying $80, is at 104. Be 104.16. So, in other words, anything above this intrinsic break-even will be profit. Anything be from 104.16 down to 102, your risk is only $80 plus commission. Of course, if the market's below 102, well, you have the equivalent risk of being long a futures contract from 102, which is $10 per tick. So in other words, if the market is 100 points below 102 come option expiration, or by the time you get out, you could lose as much as $1,000. So the trade like this is a form of a synthetic futures contract. You use a trade like this when you think the market's going to be bumpy, but you don't think it's going to go down anymore, and you think it's going to go up. Okay, and a trade like this does take a lot of the volatility out, and it's a good alternative instead of a futures contract. As you can see, as the market goes up, you go into profits quicker. And even though, as the market runs, your naked leg eventually loses all of its value. Of course, you never want to leave a short option on the table with no value, because they still have unlimited risk, even though they're valueless. If the market comes back down, they'll come back to life. This is a bull call spread with a naked leg.